Welcome to the Tech Ed Podcast, where we visit with leaders who are shaping, innovating, and disrupting technical education. People who are not afraid to think differently, not afraid to try something new, all with the goal of securing the American dream for the next generation of STEM and workforce talent. My name is Matt Kirkner, and I will tell you right now that I am a big fan of the private equity world. So if you are a technical educator, if you are an industrial employer, if you're a public policymaker, you are going to learn a ton today, and all of it is going to be relevant. I'm also a big fan of positive disruption. I'm a big fan of accelerating results, of cutting waste from processes, and yes, in the right application, a big fan of private equity. I have served as CEO of a private equity-backed company for several years. I do a fair amount of strategy work now in the world of private equity. I do some investing in the world of private equity. So I'm a huge fan. And yes, we are going to talk about what private equity is and how it works, but we're also going to talk about specifically how do things like artificial intelligence and machine learning, how are those technologies disrupting the world of private equity and finance? How does a quality and trained workforce add value to a company and to how a private equity investor looks at the value of a company? How does the availability of skilled talent, localized technical education, and workforce training affect company value? And how do those affect where investors want to invest their money? So like we said, for technical educators, for industrial employers, for public policy makers, a really, really fascinating conversation on this world of private equity with a leader in the world of private equity. His name is on the building at Borgman Capital. His name is Sequoya Borgman. He's the managing director there. Sequoya, thanks so much for being with us.
Yeah, thanks for having me. I'm looking forward to talking a little bit to you this morning.
So as you probably gathered from that intro, the world of private equity might be a little bit new to some of our audience members. So in a minute or two, if you can, tell us a little bit about what private equity is and how the model works.
Yeah, well, I think you talked a little bit about it in your introduction. I mean, achieving the American dream is what private equity does for a lot of entrepreneurs, family businesses, founders, when they're looking for an exit. Private equity pools together the capital in order to purchase those companies, be the stewards of those companies, maintain those companies, really take care of the great organizations that these founders and entrepreneurs have built. So, our firm, we're focused really on lower market leverage buyout acquisitions. So we're looking for companies all over the country that really have strong balance sheets, are established, really strong management teams, great products, great business models, and the founder or owner is looking for a succession plan. And we are one option. There's many options. You can sell to your employees, you can do ESOPs, you can do an IPO, or you can sell to private equity. And we try and be great stewards of those businesses that have been built.
So when you talk about lower market, that may or may not be a term that's familiar to our listeners. Obviously, or at least obviously to me, I think you're probably talking generally about maybe the annual revenue of a company. Well, how would you define that in terms of the size of companies you're typically looking at?
Yeah, we're Milwaukee based, so we're Midwest kind of conservative focus, and we're looking at Midwestern and companies that usually under 100 million revenue, 150 million or so, and nice companies that really haven't got the infrastructure in place to do an IPO or some of the bigger options, but really good established companies, been around 50, 60, 70, 80 years and have nice product and nice management team.
And in my 23 years of leading manufacturing companies, primarily here in the Midwest, that was always my sweet spot. I always like those smaller to medium-sized companies. You can make a decision on Monday, implement it on Wednesday, see the results on Friday. That might be a little bit optimistic.
If you can implement things that fast, you should come run a couple of our companies.
Well, I had a lot of fun in my time in private equity, without a doubt, and had some great partners in that time, and really blessed to have had that experience, and blessed now to be working on securing the American dream for the next generation of the workforce. So excited to be doing that as well. And we're going to get in, I think, in much further depth, Sequoya, into how things like workforce development and training and so on affect the value of a company and so on. But before we get into that, I really want to get into your own particular journey. I think a lot of times maybe there's a paradigm that people have about folks working in finance, working in private equity, whatever paradigm that is. I think your story is a little bit different. So tell us about your background. How did you find your way to what you're doing now?
Yeah, sure. My background is a little bit different. I started out in public accounting. Most private equity firms are either founded or launched by somebody either from investment banking or spinning out of a larger private equity firm. My background, I started out with a large Big Five firm at the time, and after getting my master's in accounting, and really learned the private equity and transaction side from the accounting side of the business. So I'm working on mergers and acquisitions, working on private equity roll-ups, and really helping structure the transactions. And that's how I learned the business. Really got introduced to private equity. And then about a little over 5 years ago, I left to launch the firm.
Awesome. So, I think, first of all, you and I are both what I call recovering accountants. I actually got my start in the same world. I was a CPA for a number of years, started as a controller of a manufacturing company, and just fell in love with manufacturing. And that became my pathway. I understand you've got some background in manufacturing as well earlier in your career.
Yeah, that is correct. Worked my way up through high school and college in manufacturing. I actually worked on assembly lines and really know that side of the business. And then started out with Arthur Andersen right out of college and worked on some manufacturing businesses there. So yeah, definitely. I always say that accounting is the language of business. If you can read financial statements, you really understand what's going on with the business. So there's no better background than somebody that knows the finance side of the business.
Absolutely. And I think a lot of times one of the things that I would run into as I went through my, my finance and accounting pathway, a lot of folks maybe made this assumption that somehow I grew up with, the old adage, a silver spoon in your mouth or what have you, and just kind of fell into this great opportunity. Doesn't sound like that was your pathway either. Is that the case? You kind of started from somewhat humble beginnings and worked your way into the position you're in now?
Yeah. I was very, very fortunate to get where I'm at right now, but it didn't start that way. I was raised by a single mother, and she never graduated high school, so not the best means. So I wouldn't say we grew up definitely on the wrong side of the tracks. And like I said, my first job, I worked in a factory when I was 16, second shift with grown adults that had been doing the same thing for 30 years, and did that all through high school and college, and it really gave me the work ethic that I think everybody needs to be successful in anything they do.
Yeah, it's just such a phenomenal story. And, we talk so much here on the podcast, and we have a number of students, as a matter of fact, who listen to us. And one of our big messages is as education evolves, as the world evolves, where you start out doesn't have to determine where you end up or where your career pathway is. And if you understand how to navigate through the right path, if you understand how to educate yourself, if you stay dedicated to that goal, it's incredible what people can achieve regardless of where they started out. And I think that part of your story is so fascinating. I want to talk a little bit now about the world of manufacturing. As I mentioned, I was a manufacturing CEO for 23 years, learned a ton in that world. What lessons would you say, Sequoya, that you learned in manufacturing that have benefited you in the world of private equity?
Well, the Midwest is just a hotbed of great manufacturing companies, and we've been fortunate to acquire several of them, and we've acquired 15 companies since we've launched, and I'd say over half of them are manufacturing businesses. And the United States and the Heartland in particular really produce some very nice, highly engineered, great products, high level manufacturing, some really world class, and we can compete with anybody in the world with the manufacturing resources that we have here, and really the stuff that's coming out, the newer automation, newer robots and cobots, and everything that's really on cutting edge right now is being implemented around the country, and we're very fortunate to be involved with those technologies and opportunities.
Yeah, the world of robotics, of automation, of cobots, so fascinating. In fact, I think the week that we're releasing this podcast, our producer, Melissa Martin, and I will be broadcasting live from the International Manufacturing Technology Show in Chicago, where we are going to have a whole slew of great episodes coming up from that show. And just seeing all that technology, we'll actually be doing some things in association with FANUC, the huge robotics company down there. Just seeing how all that technology is evolving in manufacturing from the world of manufacturing that you and I both started out in some ways has just been really, really fascinating. I think the other fascinating thing when it comes to private equity is just the wide variety, as you suggest, Sequoya, of different organizations, companies that you get to be involved with, 15 portfolio companies in total over time, and half of which have been in manufacturing. So just for our listeners who maybe are still familiarizing themselves with this model. The way that the private equity model works, of course, is an organization like Borgman Capital is going to pool capital from either investors that are committing that capital to the fund, investors who have made a decision to invest on a sponsored basis in individual deals. And over that course of time, an organization like yours creates what we call a portfolio of companies. And that portfolio of companies then really represents those investments and represents the work you do in terms of growing those companies, making them something greater and creating an opportunity and value for those investors over time. Tell us a little bit, if you would, Sequoya, about the companies that you're involved with now, about the portfolio companies that you're involved with and that you're working with presently.
We've bought companies in the telecom space. We've bought food companies. We really like the food space. Those are manufacturers for the most part. We've bought some material handling companies, bought a material handling distributor, bought an equipment rental business. We bought a business that manufactures wear parts, equipment that goes into mining and aggregates for roads and bridges and stuff like that. We've bought all kinds of businesses. So really, we're very opportunistic. Again, our focus is just nice businesses that have been around a long time, have a great management team, and really nice, steady, conservative cash flow. That's really our focus.
Sounds like a great cross-section of really Midwestern type companies, whether you talk about manufacturing, you're talking about heavy equipment, you're talking about food production. I mean, as we drive around the state of Wisconsin, around the Midwest, that is quintessential Midwestern manufacturing. So credit to you and your team for putting together such an interesting, fascinating group of companies in your portfolio. I want to talk now, and I really love the way that you kicked us off by talking about creating the American dream for individuals who may be exiting a business and exiting to private equity and creating that exit opportunity, that value for a business owner or a group of business owners as a result of all of their hard work and kind of freeing up their opportunities in the future, helping them take some chips off the table and really create the lives and the futures that they're looking to create. A lot of that is going to be dependent to some degree on, in fact, probably to a large degree, on the value of the company at the exit. In other words, if I'm a private business owner and I've made a decision that private equity is the right route for me to create that exit event and to turn that investment into cash, I'm going to be looking at maximizing that value, of course. As you look at the value of companies, Sequoya, what are some of those key factors that you see raising or lowering a company's value?
Well, really the main thing is if the owner wants to retire, most of these companies, a lot of the value is locked up in that person. That person, they've been there since day one. They founded the business or they've grown it for many, many years. They've got all the relationships. They've got all the insight and know-how, and they do a lot of sales. And that's reduces the value of the business because that person is going to have to be replaced. And a lot of times you can't replace it with one person. There's no one person who knows everything that owner knows. So you have to replace it with 3 people or 4 people or 5 people, and the cost of bringing on those professional management team reduces the value of that business. So a lot of owners really should start thinking 2, 3, 5 years before they want to exit a business about professionalizing the business, institutionalizing a lot of their knowledge, having other people lead those functions that they've really taken ownership of. And the better they do at transitioning that, the more they're going to get for their business. So that's the key thing right there. Is just how, because the big risk for an investor is you buy a business and the owner retires and the owner's all the value, and that value just walks out the door when they retire. So if you can take some of that risk out of the investment, from our standpoint, we'll pay more for that business than we would for a business where we have to take on that risk and take the time and effort. And it's really hard to replace an owner. I mean, I've said it many times. It's growing a company, being an entrepreneur. It really takes a unique individual. Go take all those risks. Most of their net worth is tied up in their business. They reinvested every dollar they've ever made for decades into this business. That's why it gets to be sizable enough to get our attention or a strategic's attention, is because they haven't taken a lot of chips off the table. So we are creating a liquidity event for these owners, and they're able to diversify, take some of the risk off the table. They're no longer personally guaranteed on all the loans. They're able to sleep at night. So I mean, it's great for these entrepreneurs, but not for everybody. Like I said, it's there for those who want to retire and maybe move to Florida or wherever people are moving these days, we're a perfect option for those types of individuals.
So hard to replace an owner. That's absolutely right. And I think a lot of times it's hard for a small to mid-sized business owner to hand off some of those things, right? A lot of them, and I'll say a lot of us, because I have been and am one in some cases, it's difficult. You know, in your brain, nobody can do it better than you, right? And so you always wanted to keep control of every aspect or as many aspects of the organization as you can. And what I'm hearing from you, Sequoia, is that if we're starting, 3-5 years ahead of time, I like the way you put it, professionalizing the leadership team, finding individuals in some of those key areas, whether it's finance or business development or technology or engineering, and handing those off to other individuals, as difficult as it may be for a small business owner, mid-sized business owner. What I'm hearing from you is that is what is going to create ultimately more value in your organization. So really, really good advice for our small business owners who may be interested at some point in creating that liquidity event and exiting their business in one form or another. We talk to a lot of small business owners here on the Tech Ed Podcast, a lot of large business leaders on the Tech Ed Podcast, a lot of educators. And some of the things that all of them are talking about in this day and age is how technology is totally disrupting their particular market space, whether it's education or industry. And we talk a lot about things like data analytics. We talk about machine learning. We talk about artificial intelligence as things that are really transforming the world of industry. Are those same things transforming private equity? Are you using any interesting methods of gathering and analyzing information and data to evaluate potential investments or to consider the future of your organization and your business?
Yeah, of course. I mean, any organizations that's not using the latest technology, they're falling behind. I mean, the world is changing at such a fast pace these days that if you're not up on the latest technology, using the most up-to-date modeling and data analysis that's available, then you're going to be passed by your competition. And we're using the latest technology we can as a firm. All our companies are upgrading or using the best technology available. That's one of the concerns of many lower middle market business, and they just don't have the resources to invest in technology that the big companies do. But the good thing is a lot of these technologies are scaling now. It's coming down market. There's ways to lease some of this technology. You don't have to have a huge investment up front, and you really have to invest in it. It's just needs to be part of the budget every year. Is to stay ahead of the technology. If not, whoever buys the company would have to make that investment, and they're going to pay less for the company. Again, it's a value driver for that business. And again, it helps with labor too. Right now, we talked a little bit about this labor shortage, but the labor shortage is one of the largest challenges that any business is facing these days. Better technology that allows you to automate not just manufacturing process, but allow your data analysis and back office functions really helps with that labor issue as well.
I think it's a really good point. I do quite a bit of speaking on things like automation, on Industry 4.0, on advanced manufacturing, and have for years. And one of the questions that always came up several years ago was, to kind of summarize it, it was, are the robots going to take all the jobs? In other words, people were really, really afraid of automation, whether that's the kind of the traditional sense of a robot performing a manufacturing operation, or as you suggest, a lot of the back office, data analytics, accounting, finance functions that can also be automated. And it scared people away. They're like, well, what are we going to do when there's no jobs? And what we found, of course, is exactly the opposite, that regardless of what market space you're in, and certainly most acutely in the world of manufacturing, I think the lack of skilled talent is really in many ways holding us back and is necessitating automation, not because we want to replace people necessarily, but because we can't find the people and need to find ways to meet demand. And so we're doing that through automation. That creates a real void in the workforce in a lot of ways. And I'd be interested in turning the conversation now, Sequoia, toward that direction. I know that, as you've suggested several times already, workforce issues are key among the biggest issues that your portfolio companies are facing. How do the workforce talent and employee training opportunities play into your perception of value? So in other words, you've got portfolio companies now that may be finding their own ways to deal with the workforce shortage. When you're looking at companies that are potential investments for you, how do you consider the value when it comes to things like workforce training and employee training?
We are highly incentivized to grow the business. No matter what you hear about private equity, our number one incentive is for every company we acquire to be phenomenally successful and continue to grow, continue the legacy that the owners have established. but really grow these businesses. And the biggest challenge with growing a business is finding the labor, not just skilled labor, but unskilled labor as well. There's just a huge shortage across the country. And in order to grow these businesses, you do have to either train unskilled labor and create more skilled labor, or automate some of those functions. We're not replacing people or replacing jobs. I mean, we're trying to meet our investment criteria by growing these businesses.
Any specific examples you have from your portfolio of some creative things that those companies are doing to address the shortage of workforce talent?
Yeah, we're really focusing on boomerang hires right now. People that have left over the last 2 or 3 years, they're already trained up. They've worked at the company, but they're sitting on the sidelines for whatever reason, or they went to try something else. Those are great hires. I mean, it is very expensive to train new employees, and not only the cost of training them, it really is frustrating for the current employees that they have to take the time out of their day and out of their trying to accomplish their tasks in order to train people. And a lot of those, then they have higher turnover and so forth. We really focused on that. I mean, we focused on all kinds of benefits, improving benefits to keep employees, being a lot more flexible around shifts and hours and people's working environment. I mean, we've tried many avenues, but again, it is very frustrating. It's just a very low unemployment across the country, and it is very hard to find good, skilled manufacturing labor these days.
And at the same time, I think we are seeing a lot of manufacturing companies trying to find more creative ways to port people into manufacturing. But let's turn our conversation, Sequoia, back to kind of your world of private equity. You know, when you're looking at what we call due diligence, so just for our listeners who may not be familiar, private equity group gets a potential acquisition under a letter of intent, which is basically agreement to acquire that company at a later time. And then goes into this due diligence phase where it's really a deep dive into, are all the things that the management, leadership, or ownership of the company told us when we were looking at this as a potential investment, how does that all stack up, and where is our risk, and making sure that we really understand the company. And that due diligence process can be very, very, it can be challenging for somebody who's selling a company who isn't prepared for it. It's also a lot of work for the people on the other side, on the acquisition side of the transaction. So when you're going through that due diligence phase, when you're looking at, okay, we really have to figure out, how are we going to grow this company? How are we going to create additional value? How does the whole workforce concept play into that decision? How do you look at things like the region's current available workforce and so on?
Yeah, we definitely look at it. We just bought a company earlier this year that was in a county that is very, very low unemployment. And it was clearly part of our diligence that it would be hard to grow that employee base. They had tried a lot of things. They'd even used work release programs and you name it to try and fill those. So we knew that either we were going to have to do more with the same amount of people, but have those people do more, or automate, bring in new equipment. And that was part of our investment thesis. Is that was kind of a known commodity when we went into that. I mean, most of the other diligence part, the financial due diligence, the numbers are what the numbers are. We use outside parties, third parties to do that. Legal diligence, environmental, customer diligence, all the other diligence functions are pretty straightforward for the most part. I mean, there are some gray areas, but the people side of the business is the one area that you really have to use your gut and do you trust the owners? Do you build a good relationship with them? The management team's telling you what you want to hear, or are they really telling you what the truth is? Because once you buy a company, it's like a long-term partnership. We're going to be with this management team, working together, having the same goals for a long period of time. And every company we buy, we put aside a large chunk of the equity for that management team to either buy in or earn if they hit our hurdles and our targets. It really aligns their interests with our interests. So these management teams, they're owners. They're owners of this business. They want what's best for the business. We want what's best for the business. And it comes down to, can we find the talent to continue to grow this business? It's a huge part of the diligence process.
And I will certainly echo what you just said, having, again, been involved in the private equity world myself and been the beneficiary of an exit event at one point in my career, that if things go right, they can go really, really well for the management and the leadership of that team through their partnership with the private equity investor. But to your point, making sure that whatever's being talked about and discussed in management meetings, pre-acquisition and in due diligence, you're going to have to live by that on the other end of the transaction. So be careful what you promise to that private equity partner, because somebody's going to hold you accountable to all of that. And I can certainly attest to that side of things. I think the other part of your answer, Sequoia, really speaks to anybody working in public policy. I spent a day or so 2 weeks ago with a number of economic development folks in our region in Southeast Wisconsin talking about, they just told me, they said, every time we have a large company that comes and looks at investing in our region, the first question is, talk to us about workforce. Talk to us about your technical colleges, your community colleges. How are you handling workforce development? Are your companies building training programs into the culture of the business and so on? It has a huge impact, not on the value just of an individual company, but on the overall economic success of a region. And so anybody who's hearing that, who's considering investments in continued training, benefits not just the workforce, which is huge, but also the overall economic development of an entire region. So speaking of entire regions, you and I are both Milwaukee, Wisconsin folks these days. I've spent almost my entire career in the Milwaukee area. And it's one of the things I love about it is it's this corridor really running from maybe Oshkosh, Wisconsin down through Chicago. It's one of the busiest corridors of manufacturing in the entire country, probably the busiest corridor of manufacturing in the entire country. So what's your take on the future of Midwestern manufacturing as we see all this evolution in technology and automation in manufacturing and workforce? Is it a good place to put your money these days, and why?
Oh, I think it's a great place. I mean, as we've seen over the last 2 years with the rising costs of transportation, shipping, and really logistics challenges of getting things back here domestically, a lot of companies have reinvested in their domestic business. And this region, since we do have the manufacturing capabilities, the engineering capabilities, it's going to be a huge boon for a long period of time. I mean, a lot of those investments are just now being made with supply chain. I mean, if you're building a new manufacturing facility, you're looking at 18 months out or 2 years. If you're bringing in new equipment, you're looking at 12 to 18 months for that equipment to get on board. I just see it's going to be a huge boom for the next couple of years as a lot of this starts coming online, a lot of this manufacturing capability, capacity. And it's going to be great jobs for the region, great opportunity. And I don't see with the geopolitical challenges we're seeing right now that flipping the other way. I mean, the wage differentials, a lot of that's coming down because of the automation and what's going on from a manufacturing capability. So having kind of a shorter supply chain is much more important than a little bit higher cost of labor.
You and I see that exactly the same way. One of the things that I've gotten accustomed to saying is that obviously the pandemic was just incredibly difficult for so many people and affected so many different lives in negative ways, but it hasn't been without a handful of silver linings. And one of those silver linings is that I think people outside of manufacturing now understand what those of us inside of manufacturing knew all along. And that's just this incredible value that regional manufacturing brings to the economy. And, when you could get what you wanted, when you wanted, at the price you wanted to pay, or at least a price you found reasonable, it was really easy to take supply chain and manufacturing for granted. And now we're here in this world where if you can't get that, and we know what it's like to have a disrupted supply chain, now all of a sudden we understand the value of having production a little bit closer to the point of consumption and not creating all this variability and barriers to getting people the products they need. I think that is only good for Wisconsin manufacturing, for Midwest manufacturing, and U.S. manufacturing. And to your point, the ability to now use automation, to use technology to drive cost out of manufacturing, some of those competitive benefits that other low-cost regions may have had, those are starting to be mitigated a little bit, and some of the benefits of regional manufacturing are starting to outplay those. I think it's a great place to be as well. It's a really exciting time to be in American manufacturing. So I want to just a couple minutes that we've got left here, Sequoia, talk a little bit about some advice. Now, you talked about earlier in the podcast, the value of professionalizing your leadership team. If you're an entrepreneur, if you're a one-person show and you kind of do it all, being able to hand off some responsibilities to others and build a leadership team, provide some really good backup plans and some security for a potential investor, helps them mitigate risk a little bit. Other advice that you would have for an owner of a company who's listening to this podcast, outside of the professional management team, what is one thing that they could implement in their company that would raise the value of the business?
Well, I mean, right now, the biggest thing is with inflation. I mean, you have a lot more pricing power with current demand. So anything you can do to increase your margins is definitely going to help your business. And really, if as long as you have staying power with those customers and you can show a buyer that you're going to have long-term customers that have been with you a long time, that's going to increase the value. Professionalizing it, of course, upgrading your IT systems, upgrading your HR and all your other systems. And the other thing, even if you're not thinking about selling, I mean, you cannot micromanage a business and it still continue to grow. There gets to be a point in any business where the owner only has so many hours in a day. They can only do so much. They can only micromanage so much. So even if you keep the business and you want to continue to grow, many businesses get to 10 million or 20 million or 30 million or whatever the hurdle is, not because the business doesn't have the opportunity to continue to grow. It's because the owner is trying to do too much and they become overwhelmed, or they get to a lifestyle where they're very comfortable and they're happy and they don't have any incentive to grow that business because life is good. Where we don't have those hurdles. I mean, we continually want to grow those businesses. And that's one of the values we bring to these businesses. Nobody's more aligned than private equity and growing businesses. And we talked about that a little bit earlier in the podcast. But really, the value is professionalize the business, really think about what you want to do. And you don't necessarily have to sell the business too. You could hire a professional president, maybe incentivize them with equity and be more hands off. Move to Florida or Arizona or Texas or wherever, and let a true professional management team run that business and still live a really nice lifestyle and maintain that business. I'd prefer for you to sell it to us, but there's lots of options. If you are a successful entrepreneur, there's lots of buyers and lots of options for you, and just take the time to think through what you really truly want out of that business. I mean, a lot of times, that business is these entrepreneurs, owners, really their baby. They built it from nothing, and they're in the driver's seat. They have the options of picking who they want to sell to, or if they want to sell at all.
Well, and I think one of the other disadvantages of micromanaging, and I've worked in organizations where the leader of the organization was, for whatever reason, couldn't let go, is you really stifle growth on the part of the team, right? So if you're the person that wants to do everything and you've got somebody that's working on that team that has their eyes on maybe doing something entrepreneurial or taking on more responsibility, or in this day and age, more and more people, I think, want to work in more of an independent work environment. And if they've got somebody that's just around telling them what to do all day long, it becomes really hard in some ways to grow and expand that next level of leadership, because people who are really true, good, independent leaders are probably going to find their way somewhere else where they get a little bit more opportunity to spread their wings. So lots and lots of reasons for individuals who are leading companies to, as you put it, professionalize the management team, don't micromanage so much, and find ways to basically free up your time and free your business to continue to grow in a way that doesn't stifle the growth because you're trying to do too much. So really, really good examples and really good advice for a business owner. If I'm one of those business owners, Sequoia, who's interested in selling my company, or maybe I'm somebody who's listening who's like, wow, this whole private equity world is an interesting investment vehicle for me, and I'm in a position to be able to do some private equity investing. How do they learn more about Borgman Capital?
They can come to our website, borgmancapital.com. My contact information's on that site, and we can get connected through that.
Perfect. Sequoya Borgman is our guest today on the Tech Ed podcast. He's the managing director of the company with his name on it, Borgman Capital, a private equity group in Milwaukee, Wisconsin. One of the questions we love asking people, and you've got such an interesting path to the position that you've managed to grow yourself into. If you could give one piece of advice to a high school sophomore as they consider the future of their career pathway, what would that piece of advice be?
I would say take risks early in your career, learn about capitalism, learn about entrepreneurship, and really that's where most wealth in this country has been built through entrepreneurship or capitalism. One of those two avenues, and sometimes you can follow both, like I did. But that would be my number one advice: take risks early when you don't have as much to lose. Go start a business, go learn about a business, and then start your own business, or really get on the ownership side of a business early, in your early 20s, mid 20s. That's the best, no better time to start entrepreneurship than right out of school.
Yeah, I couldn't agree more. I think back on my career pathway, and it was a lot easier. And it didn't seem that way necessarily, but looking back on it, it was a lot easier to take risks those first 3 or 4 or 5 years out of whatever your education pathway was in my case. Then once you have a house, a mortgage, kids, a wife, and all these other responsibilities, and not that you can't do it, but boy, it weighs a lot more, and it's a much bigger risk when you have all these other individuals who are, counting on you for their livelihood. So that's really, really good advice. And of course, the focus on entrepreneurship and capitalism, you won't get any argument out of me there either. So what a wonderful conversation we've had today, Sequoia, learning about private equity, learning about how we can grow value in businesses, learning about that really important element of workforce training, of workforce development, and the availability of a workforce in determining value of a company, and where an organization like yours wants to put its money and wants to put its investment. So as we think back on where we started, which is great, first of all, really, really good advice for anybody who's leading an industrial company. We covered a lot of really interesting things for anybody who's involved in technical education and on the public policy side. So I just want to thank you for some really, really interesting and thought-provoking comments, and for spending some time on the Tech Ed podcast today.
Well, thank you for having me.
Thanks for joining us for this episode of the Tech Ed podcast. If you haven't already, subscribe, leave a review, and if you like this episode, share it with a friend. New episodes launch every Tuesday, so listen in next week.